And we've got a couple more people logging in here, so we'll just give it another 20 seconds or so. Dalyce, if you want to go to the next slide. So my name is Cindy Lindsay, and I'm the Director of Learning and Network Engagement with Community Foundations of Canada. And as I said, I'm really glad that you can join us today. We're starting to wind up our series of webinars for 2020. It's been a crazy year for learning, and we're just so glad so many of you have been part of this journey with us. I'm calling in from my home in Elora, Ontario, and would like to acknowledge that I live on the traditional territory of the Attawandaron, Wyandot, Mississauga, and Haudenosaunee First Nations. This is known as the land of the Between the Lakes Treaty and the Haldimand Tract. And I'm immensely grateful for their stewardship of this land, and as we humbly seek to live together in the pursuit of justice and right relations. And I'm thrilled to also introduce my colleague, Tracy Vavrick. Tracy, do you want to say hello?
Good morning. Thank you so much, Cindy. And it is wonderful to see so many beautiful faces and friendly faces that have joined us today. I join you today from Grand Prairie, Alberta, and I am pleased and honored to be able to connect with you, all of you, from Treaty 8 territory on the traditional lands of the Métis, the Kelly Lake Métis Settlement Society, and the Beaver First Nation. And I'm committed to learn the history of the lands that I live on, and I'm extremely grateful to share these lands as I continue to support my community and also support those that are within our communities. And again, it is so beautiful to see everyone today. I see some friendly faces, some faces that I've worked with many years, including the community foundation that I was part of for over 19 years from the Community Foundation in Northwestern Alberta. Honored to see everyone join us. I'm going to pass it back to you now, Cindy.
Okay, great. Thank you, Tracy. So Tracy and I are your hosts for today. And just a couple reminders, especially if you haven't joined our webinars before. If you are not on mute, please do so now, just to avoid any background noises and distractions. We do want to ensure that you get your questions answered today. And we will do that by using the chat box. And we have time set aside at the end. We've got some great content today. So as you think of questions, please put them in the chat box, and hopefully we'll have enough time to get through them all. If not, we will follow up with you as well with our presenters. We are recording this session, and it will be available in the CFC Resource Library in the next couple of days, and you'll receive the link for that. In order for you to get the best viewing experience, please close all other applications just to avoid any pop-ups, and make sure you've got your volume nice and loud. Next slide, please, Dalyce. So it's my pleasure today to introduce or welcome Trevor Hunt and Dalyce Seitz, who are both investment managers, investment counsel with Leith Wheeler Investment Counsel in Canada here. Leith Wheeler is a great partner of CFC, a supporter of our Vital Signs program. And if you were in our at our conference in Victoria last year, you may have met Trevor, because he's a very engaging fellow and loves to meet with people. But I will turn it over to you, Trevor and Dalyce, to share a little bit about yourself and go ahead with the presentation.
Well, thanks so much, Cindy. I hope I don't disappoint everyone after that build-up. Hi, everyone. It's a pleasure to meet with all of you today. As Cindy mentioned, my name is Trevor Hunt, and I'm a portfolio manager with Leith Wheeler Investment Counsel. I'm based in our Toronto office. However, I'm coming to you today from my home in Aurora, which is pretty much where I've been since March. I'm responsible for foundation, family office, and private client portfolios. In terms of where you might find me on the weekends, if I'm not looking after my 3 young kids, then you'll probably find me on the golf course or tennis court in the summer, and during winter, skiing very badly on the bunny hills. I'll pass over to my colleague, Dalyce Seitz, who's in Calgary, who can introduce herself.
Great. Thanks so much, Trevor. Hello, everybody. Such a pleasure to be here with everyone today and helping with such a wonderful initiative. As Trevor mentioned, I'm one of the portfolio managers here in our Calgary office. And having grown up in both Calgary and Lethbridge, I spend the majority of my time working with clients from all over Southern Alberta. Here in Calgary, we're pretty fortunate to have the Rockies in our backyard. So if I'm not in the office, you can usually find me out hiking or snowshoeing, skiing with friends and family.
Great. So I think we can begin our first slide. And this is not nearly as exciting as watching the run up to the US elections. However, it is an important disclaimer that we need to address up front. Please view this presentation for informational purposes only. Thinking about our partnership with CFC at Leith Wheeler, it's important to us as a firm to give back to communities across Canada where we live and work. And before we began our relationship with CFC, together with JP and other senior CFC team members, we spent a lot of time exploring how it is that we may be able to partner together. And very early on, for both sides, it became clear that we had significant shared values. And that was going to be a really, really good fit from the start. In particular, vital signs really appealed to us. If you can appreciate, we're an investment management firm, so dealing with numbers and data, we recognize the importance of data-driven decision-making, and we acknowledge the output and power of vital signs programs, and we are very proud of this partnership with the CFC movement. So in terms of the main topics that Dalyce and I will be covering today, the first, Dalyce will begin with taking a look at the myriad of investment choices available to foundations in the Canadian landscape. I will then try not to bore you too much with the importance of an investment policy statement, but notably adhering to an investment policy statement during those critical times. Dalyce will then address some ways to evaluate your investment manager and managers. And finally, I will finish with some benefits of creating a reserve fund. Dalyce, I'll pass over to you.
Great, thanks, Trevor. So selecting the right investment manager is so critical when it comes to safeguarding the assets of and endowments of any community foundation. So the right investment manager should not only help improve your bottom line, but provide so much more in terms of helping you achieve those goals and objectives. When I took on this part of the presentation, I thought, okay, where do I start? How do I break this down simply for everyone listening? And to be honest, it was a little bit hard to do. The options available within this universe can be overwhelming, even for those of us who are seasoned in the industry. A simple Google search, as you can see here, pulls up endless names, and this is certainly far from an exhaustive list. So there's a variety of firms here, and we can generally separate them into two categories. Independent firms, such as ourselves here at Leith Wheeler, or perhaps Connor, Clark & Lunn. And then you have your bank or insurance-owned options, such as TD Wealth or RBC PH&N. So bank-owned versus independent could be a good place to start. But the truth is that even within one firm, there can be multiple business lines, ranging from purely transactional brokers or salespeople to your full service investment counselors and portfolio managers. So as we'll see on the next slide, this isn't the only layer of complexity within the industry. So not only are you wading through a sea of options regarding the investment firm, but there's also the critical relationship that you have with your primary advisor or team to consider. You'll notice here that there's a large number of titles and designations that float around in the industry. In blue, you can see some like financial advisor, investment counselor, portfolio manager, and in gray, each of us also carry a variety of different designations, from certified financial planner or even chartered financial analyst. So you'd be forgiven for not realizing that some of the words you can see out there in the industry, like senior or vice president, they don't necessarily relate to proficiency as an investment manager. It might be the assets under management of that specific advisor, or they may have even negotiated the title as part of a signing bonus with the firm. So unfortunately, much of the industry is still focused on salespeople, and good asset gatherers are rewarded heavily by some of the institutions. We've all heard the stories about being promised the world at the outset and then hearing from your advisor once a year, because they're often encouraged to keep growing, and compensation focuses their time on the next opportunity. So this isn't meant to downplay the hard work that goes into many of these designations and roles, but from the perspective of a community foundation selecting an investment manager, some definitely matter more than others. Just as you have a duty of loyalty, diligence, and skill to your stakeholders, your investment manager should have a fiduciary responsibility to you and your foundation. And this is really similar to what any lawyer or accountant has to their clients. And this gold standard of care actually doesn't come down to a title, but instead it comes down to how the individual is registered. And I'll show you a little bit about this on the next slide. I certainly won't get into detail here on the different regulatory bodies across the country, but given the special care owed to your stakeholders, it's our opinion that you should certainly be working with the most highly regulated individuals in the industry. And the specific registration category that comes with the most stringent requirements when it comes to education, industry experience, and ethics is known as an advising representative, which you can see on the right-hand side of the screen here. So, of course, to make it complicated, you're not likely to see this on a business card or any marketing material, and it certainly doesn't have as much flash as some of the titles that we saw on the previous page. The website that I have linked at the top here is a great resource, but here's kind of 3 important points about what to look for in an advising representative. Advising reps must all be registered with their provincial securities commissions. So, for example, the Ontario Securities Commission. Advising reps must have at minimum their chartered investment manager designation or their chartered financial analyst designation. And these are most often associated with the titles of investment counselor or portfolio manager in this space. Advising reps must check all the boxes when it comes to relevant investment management experience. So this means they've spent time analyzing and researching securities and they can prove it. They've had experience creating investment policy statements, and they've been managing portfolios for the required amount of time. So I was actually pretty surprised to be highlighting here that less than 4% of the individuals registered across Canada are actually registered under this advising representative designation. Lastly, change is constant. There's even a new registration category on the horizon, and it's a mouthful. It's a client relationship manager advising representative. It's just food for thought. This one might just make it easier for those whose focus has been more on sales to take on the title of portfolio manager. So moral of the story is make sure you're asking your advisor and make sure you have a good sense of what their qualifications and registration are. Clear as mud, right? So I'll move on here. Once you've narrowed down the universe of firms and advisors, you move on to a short list of candidates. This slide shows some of the metrics that should guide you fairly well in terms of further analyzing the options in front of you. It's a short list. Some of the more qualitative considerations from culture and shared values to more of the quantitative metrics such as performance data and fee structure. Personally, I like to explain this to my clients as a bit of a balancing act between the brain and the heart. So to truly realize the goals and objectives of the foundation, you certainly want to have a technically sound and well-performing portfolio, but you also need to have open communication, shared values, and ensure everyone is keeping their eyes on the big picture. Truthfully, we could talk for an entire day or an entire week session on the nuances within each of these categories. And many of the items do double duty and could fit on both sides of the chart. But what's most important is that any prospective investment firm or advisor can talk clearly to these points and more. So we did come up with a framework that might help as a starting off point for someone or a foundation, and it's to consider the 7 Ps. So when it comes to the people that you're interviewing, is the team experienced? Are they successful? And has it been stable over time? Parent or ownership. So what is the ownership structure and does it align with the needs of your specific foundation? When it comes to philosophy and process, the guiding principles and the processes in place to maintain them should be clearly defined by the investment firm. And does it seem repeatable and disciplined? Does performance meet the mark, and does it seem consistent? And does the team have passion? So do they seem motivated by the right reasons, and do you believe that they're here to stay? It's worth considering if the person you're working with is an owner and acts like an owner, or do they rent the chair that they're sitting in? And price, are the fees fair and are they transparent? On the flip side, we've also created a short list of red flags to consider. I won't go through all of them, but they're essentially kind of the opposite of what you should be looking for in an investment manager. So to highlight just a few, if there's very low or zero employee ownership, are the interests of the advisor aligned with those of the clients, and what is that focus? Beyond that, if there's concentrated ownership, how does the firm intend to transition that ownership on a go forward? Employee turnover is another red flag. Are the individuals responsible for the track record that you're being shown still there? And do you have confidence in a consistent advisory team over time? Maybe the biggest red flag is an inconsistent investment approach, which you can see kind of close to the bottom here. So do the investment firm's actions match with a clear set of standards, or have you noticed any flip-flopping or capitulating on stated disciplines in order to chase performance during difficult markets? If you have, it's certainly a red flag and worth exploring with your advisor and the firm that you're working with or interviewing. So the next few slides, they're going to highlight just a couple of these key metric examples that we thought might be pertinent to a community foundation. So ESG, environmental, social, and governance factors. The focus on responsible investing is only growing, and depending on the specific values of your organization, you may wish to make this a focus. So for example, is there a mission, a value, or a belief that you want to govern your manager's investable universe? Assessing the quality of management is a key part of our process here at Leith Wheeler, just as an example. We find that companies with strong leadership who are also good stewards of capital are often committed to doing right by their employees, their communities, and the environment. So owning large shareholdings on behalf of our clients, it allows us to engage meaningfully with management, and it allows us to communicate our expectations regarding their ESG practices. So we take this seriously and we ask tough questions, environmental factors, safety, compensation strategy, what's the level of female representation, and other important aspects of diversity in the workforce. And if a CEO can't answer one or more of these questions, we certainly treat it as an internal red flag. So if this is important to your organization, the right investment manager should be able to clearly articulate their position, as well as work with you on how to incorporate your own values into your specific investor policy statement. Similar to designations and titles, fees can be another source of confusion for many investors, and these can generally be broken down into three categories. Your fee-for-service advisor charges a flat fee. This tends to be a sliding scale depending on assets under management. So the larger the portfolio, the lower the fee. But a reasonable starting point should be in the range of about 0.5% for any not-for-profit or foundation, and upwards of about 1% for individuals. So ultimately, this type of fee structure tends to be the best one in terms of aligning client and firm interests, and is certainly becoming more of the standard. Be sure to ask if your custodian fees are included inside your management fees, and don't be afraid to ask if an investment manager offers any special discounts or incentives to not-for-profits. Product fees can be a bit of a tricky one and often fly under the radar. They're probably the least transparent of the three here. Even the fee-for-service advisors above might be using pooled funds, mutual funds, or ETFs that carry their own additional fee, and this can more than double your all-in cost. And transaction fees at the bottom are becoming less and less common, but are a pay-as-you-go arrangement, so costs are incurred based on trading activity. A good analogy that I heard, I won't take credit for it, but I think it's good, is that fee-for-service advisor is kind of like your all-access package with Netflix. So your monthly fee includes access to any of the content you want at any time. Product fees are the additional add-ons. So you could think of this as when Disney Plus was charging a premium to watch Mulan, or Crave charges extra if you want to watch the HBO packages. And transaction fees were like going to the theater. So you pay per use, but depending on your budget, you might actually come away feeling like you really didn't have the ability to access all of the content or the movies that you wished you could have seen. This next slide is an example of just how much of an impact that various fees can have on the long-term growth of a portfolio. So we see here we've taken a $10 million portfolio and we've stretched this out over 20 years, assuming a 7% annual rate of return and accounting for that 3.5% kind of standard annual distribution for a community foundation in particular. So, you know, these lines are pretty straight and upwards, and obviously we know that markets don't work quite this smoothly, but time and compounding is certainly your friend. But what we can see here though is the difference that even just 0.5% makes to the dollar values of a portfolio over time. So at the 0.5% fee, you end up with the 18 or just over $18 million on the right-hand side there at the top. And this becomes only 13 million with a 2% fee. So it's surprising how often we come across foundations that don't really realize that they're paying closer to that 2% mark all in when you think about the advisory fee plus the product fees. So it's important to get full clarity from your advisor. In summary, for this topic here, a great advisory relationship aids with the investment policy construction. It's disciplined, it provides consistent communication and performance, and even emotional coaching and more, which Trevor will talk to a little bit more in a moment. Due to the complex and specialized needs of a foundation, it's really important to ensure you're working with a firm that has the right people, products, and drive to support you. And the best choice is always going to depend on your specific goals, objectives, and constraints that your specific foundation might have. The right investment management firm can help reduce your overall risk, share the duty of skill, diligence, and loyalty, and help increase trust in the board and executive directors. It can also help take the load off of those on the front line. And with that, I will pass the floor over to Trevor.
Great. Thanks, Dalyce. So on this slide and in this section, we're going to address the importance of an investment policy statement. As board members, staff, and investment committee members, and us as investment managers, we're all stewards of capital, and we have that fiduciary responsibility to plan appropriately. The vast majority, if not all, community foundations already have an investment policy statement in place. And as you know, it acts as a roadmap for staying on track. But it's typically designed during calmer times. In this section, we're going to be focusing on the importance of adhering to the plan during those moments of crisis. So Dalyce, if we could just go on to this sample and of an investment policy statement, and I won't spend too much time on it, but what it shows is an oversimplified summary of inputs that may go into an investment policy statement. And in terms of observations that we are seeing, certainly, you know, one might be that there are target returns that are being augmented. So the nominal target return is being augmented with an inflation plus target, such as CPI plus 3.5% or CPI plus 4%, as we've shown in this instance. And the second observation, which Dalyce had already touched on, is that we're seeing an increasing number of foundations expressing their views on ESG and shared values through requirements for their investment managers to follow an ESG integration approach towards their decision making. Arguably, the most important input from an investment perspective when we're looking at these various different inputs is asset allocation. And so asset allocation is the largest determinant of portfolio returns. In this sample asset mix, we have a very standard 40% cash and bonds and 60% equities as set for the long-term target allocation. And then we've just shown a set of minimum and maximum ranges for each asset class. Now let's take a look at an illustration showing the impact of deviating from that IPS, especially at a critical time, such as the one that we all experienced in March earlier this year. In this example, in all three scenarios, the portfolio value started at $5 million coming into the year, into 2020. And all three portfolios originally had an asset mix of 40% bonds, 60% equities at the beginning of the year. Portfolio one, which we call the panic portfolio, is an extreme example. And if the decision was made at the 31st of March to sell the portfolio and not reinvest it, the value of the portfolio would be $4.5 million at the end of October 31st this year. And then if we take a look under scenario two, this portfolio is slightly panicked, and the decision was made to flip the asset allocation to a more defensive positioning. So from 40% bonds, 60% equities to 60% bonds and 40% equities at the end of March. The portfolio would not quite have recovered back to its starting value at the end of October this year. And then finally, if we look at portfolio three, following a disciplined approach of rebalancing the portfolio back to the long-term target as stated in the IPS, the portfolio would have recovered all the unrealized losses and gained a little bit to the end of October 2020. These do not include any distributions or spending, but the point is that without a playbook, some investors may have been tempted to react to emotions. So this is just an illustration of the perils of not sticking to the plan. If we take a look at the next slide, in the previous slide, we looked at the impact of changes to asset allocation. The same can be said, and the same message is true for frequent changes to your investment managers and investment strategy. So in this instance, Vanguard conducted a study to quantify the impact of performance chasing. The methodology that was followed was using a 3-year rolling returns. Every year, if the fund was below the median 3-year annualized return, that fund would then be replaced by the top performing fund over the previous 3 years. They looked at real fund performance data and ran millions of scenarios against buy and hold strategy. And as you can see in this graph is that in every single classification, whether it was small, mid caps, large caps, or style of manager, growth, value, blend, the buy and hold strategy was superior by a margin of between 2 to 4% per annum over a 10-year period. They concluded for investors using active managers, it's critical to understand the short-term performance should not be the sole reason to enter or exit the fund. Now, this is just one study, but this is one of many that tell a similar message. George Mason University looked at the 10-year return gap for investors, which is the impact of switching in and out of funds. And they included in their study institutional investors. So despite having sophisticated investment committees and consultants, even pension plans experienced a leakage of between 1 and 1.5% per annum over a 10-year period from switching funds. So let's talk about how what might happen and some of the traits that we are all prone to if we think about why this has occurred. So short-termism is a behavioral bias that we all have. Here is one definition pulled from the CFA website. The question that we should ask ourselves is, why do investors with long-term horizons battle with short-termism? And the three primary reasons, today we have an abundance of unhelpful data in this information age that we live in. And secondly, there is an emphasis in our industry on short-term performance. Companies report quarterly earnings, and you receive quarterly investment reports, and we produce quarterly investment reports. And then finally, the short-termism is ingrained in us as a behavioral bias. So if we just flip to the next slide, well, what can we do to avoid short-termism? This is more of a fun slide than anything else. It's easier said than done to be less reactionary and emotional, especially at those critical moments. However, the overriding message that we'll see in a few of the following slides is that sticking to the plan will have a greater probability of delivering on those long-term promises. So one thing we can do, and Dalyce, you can click through. I know that there's a couple of, yeah, you can click. That's perfect. Thank you. First, it's not easy to do this for any of us, and however, we aim to block out the noise as much as possible. I was researching the subject on Google, and for some reason the Gambler came up. Kenny Rogers hit from the 70s. I thought the lyrics were appropriate for this message, especially the last line, know when to walk away. There was one fund manager in London, England, who used to track his investment decisions. Over time, he would look back at his track record, and he discovered that on volatile days that were marked daisy, he would perform better than on those volatile days that were not marked daisy. Daisy was the name of the fund manager's dog, and on the days that he forced himself away from his screen, he would take Daisy for a walk. And on those days, it would lead to better investment decisions. If we can move on to the next slide, Dalyce, and maybe this ties in with the Vanguard study. If we think about investment strategy or manager selection in the context of running a race, let's take these two athletes as examples. Both of these athletes run for the fastest time. However, one is a sprinter and the other is a marathon runner. If we measured the marathon runner based on his speed over a 100-meter sprint, then we're unlikely to select the best marathon runner. But we'll look amazing for a short while, by selecting a sprinter. We then may fire the marathon runner or the sprinter and pick another 100-meter runner and repeat the process over and over again. These two athletes train differently, they are built differently for different specific disciplines, and therefore we shouldn't be measuring them differently. So if we just flip to the next slide, unfortunately we'll never have a vaccine for behavioral biases. There is no one silver bullet. We can train to be aware of them. We still, even if we are aware of them, may fall into traps. And I think that one of the data points that really stays out in my mind is that, you know, from an investment perspective, missing the 10 best days of a bear market over the last 40 years could have detracted 2% from investment returns annualized over that period. We're going to finish off where we started this section. A goal without a plan is just a wish. Short-termism is like an investor who rides a bicycle by keeping her eyes on the fixed on the front wheel. There are certainly times when you need to be concerned with immediate circumstances, but to really ride safely, we must all look ahead at where we're going. I'll pass over to you, Dalyce, to cover the next section.
Great, thanks, Trevor. So now you've been working with your selected investment team. How and when do you possibly go about evaluating them? Trevor's comments there about short-termism lead really well into this topic, as it's all too easy to get caught up in the short-term performance noise, lose sight of the bigger picture when it comes to measurements like this. It's pretty natural for the mind to jump purely to performance data here. And while this is of course important, there's a lot of other factors at play when it comes to evaluating your investment manager. Once again, I feel like we're looking at this from a fairly high level due to time constraints, but as a baseline, I would say, think back to those key metrics, skills, and specific goals that you had in mind when you went back to hire the manager in the first place. Go back to the investor policy statement and review what the roadmap was meant to look like and compare it to your reality. Your investment manager should be very helpful throughout this process, and you should feel really quite fully informed about what the expectations were versus the reality. So if we look back at the framework that we saw during the hiring process, these are just a few of the questions that you could consider on the qualitative side. But probably most important for any foundation is to just make sure that you've developed a process for yourselves that's consistent and measurable, and the investment manager should really be an active partner in this process. So is the manager meeting your communication expectations? Do you feel well advised of the overall investment strategy, how you're tracking, and what the current market outlooks are? Does the team that you're working with continue to be a good cultural fit? Do the foundation values still align well with the investment strategy? And do those ESG principles remain current and well aligned? From the more quantitative perspective, you could really dig in here. You may or may not be familiar with terms such as benchmarking, upside, downside capture, but those are an entire topic on their own. Generally though, expect at least quarterly updates from your manager, ask for more if you need it, have open communication about what works best for your community foundation. You know, it's quite standard to use a 4-year rolling average when it comes to performance. Try your best to keep focused on the overarching goals and remember that the past doesn't predict the future. You know, as Trevor mentioned during his presentation there, that performance gap is real. There are real life impacts of switching investment advisors at the wrong time, just as there are of switching the type of investments that you're holding at the wrong time. So it's been well shown that when separated into the skilled, the mediocre, and the unskilled investment managers, the majority of short-term outperformance actually comes at the hands of the mediocre crowd. So keep focused on the discipline, keep focused on whether or not you feel comfortable with your manager's rationale. This is maybe one of the most overused sayings, but you know, Gretzky said it pretty well. You're not skating to where the puck is now, you're skating to where it's going to be. So from a quantitative perspective, how is the investment manager performing relative to stated targets in the investment policy statement? Are there any changes required based on your cash needs? How is the manager performing against peers with a similar style given recent economic events? And remember to keep your eyes on at least those 4-year rolling averages to give the opportunity to see the long-term trends. These funds, you know, have some of the longest time horizons out there. And so it's really important to make sure that that legacy is kept intact and doesn't get lost in the shuffle of short-termism. So I'll pass over to Trevor.
Thanks, Dalyce. And you can click through the slide because there are a couple of lines that come on this chart. Great. So switching a gear slightly is and looking at sustainable payout over time. Sustainable payout is what you can spend while not touching your capital in your portfolio. And so what you can see, and I can share, I'd be happy to share the full methodology with you on this, but what we looked at is 5-year rolling returns of portfolios of various different asset mixes. And the findings of this is more directional than anything else. As you can see, the sustainable payout today is sitting at the lows not seen since back in the early 80s. And this is given largely because of the low interest rate environment that we find ourselves in. So if we think about a 10-year government of Canada bond yielding 0.7% today, foundations are faced with that difficult discussion on whether to increase risk in their portfolio to meet their target returns or to moderate their target return. And in either case, it's not an ideal scenario, but it's a difficult conversation that investment committees are having today, and we are certainly having those with our clients. The good news is that this is cyclical, and so over time, the sustainable yield should recover. So what kind of techniques can we use to combat a low return environment? So let's have a look at the next slide. And one technique that some foundations may adopt is to act as a shock absorber on those rainy days, is to establish a reserve fund. So build up a separate isolated reserve fund. When there are significant global events and those rainy days feel more like torrential downpours, everything suffers all at once. Your portfolio returns are weak, donations dry up, and at a time when people need help the most. And so if I could just take a pause and ask everyone a quick question as we go on to the next slide. And maybe you can write this in the chat box. And Cindy, if you could call out one or two of the answers that you might get. But can anyone tell me how many times the US stock market has fallen minus 20% or more since the 1920s? And so a bear market is defined by falling 20%. So if there are any best guesses, please write them in the chat box.
We're just going to wait for some. Oh, we have one that says 5 times.
Yeah.
Anybody else willing to give it a shot? 25 times in 6 months.
Okay. All right. Well,
there's another one. Twice under 20% in 2 years to recover. Oh, we got some pretty savvy.
Hey, well, someone getting very exact. So the last one, and 2 years to recover is almost bang on, and that's really important in the context of thinking about how much money you may need to set aside in your reserve fund. So here's a table. If we go into the next slide, which actually tells us the answers. There's been 15 bear markets, including this year, since the 1920s for the US equity market. And the average decline, as you can see, is 39% for these bear markets. And notably, it's 22 months on average to recover. So having that 2 years buffer may be very reasonable for a reserve fund to consider. And so in this example, this illustration, we're just showing how a reserve fund can be created. So if we think about 2019 being a very strong year for investment returns, and again, the standard 40% bonds, 60% equity portfolio, we started the year at $5 million in 2019. It might be worth just over 5.7, maybe 5.8 after a 15.7% return in 2019. And so after accounting for distributions and expenses of about 4.5% of the value of the fund, the portfolio value at the end of 2019 would have been just over $5.5 million. And so if the decision at that point was to carve out another 4.5%, just over 4.5%, which is $250,000, and put that into a reserve fund and leave the remaining balance in the long-term fund to grow over time in the risky portfolio, it would have made 2020 a lot more easier and a smoother ride for foundations. And that reserve fund of 250,000 could have been used when the long-term portfolio was struggling in terms of distributions and also in terms of expenditure. But not only that, the foundation may have also taken the view that because of this buffer, they could donate more than they typically would to people and charities that needed it most at the most extended times.
So I'll just do a quick summary here of the 4 topics that we've covered today. One, there's various different types of investment relationships out there. So choosing the right fit will improve your community foundation's probability of achieving its objectives. It's not an easy task, but by having the right questions in mind, you should be well prepared. Turbulent times are inevitable. The community foundation will have a greater possibility of success by staying the course. And that often comes along with a well constructed investment policy statement, and then having the right investment manager there to guide you through some of those common biases and hiccups. Just like vital signs, the right data and information is so important in order to evaluate your investment manager. Again, knowing those right questions to ask is crucial. And lastly, a reserve fund can act as a shock absorber for those bumps along the road. So I'll just add that in the interest of time, we've covered a lot of material here today at a fairly high level. There's certainly further discussion and detail that could be covered about more of the technical factors within each of these topics. So Trevor and I would be more than happy to host a more focused or tailored seminar on any of these topics of interest here today. So please don't hesitate to reach out if you'd like. And with that, I think we can open it up to questions.
Great. Thank you, Trevor and Dalyce. This was terrific. Some wonderful, great information and solid information. So I appreciate you taking the time to do this. There are a couple of questions. One is, please give us your thoughts on using alternative investments as part of a portfolio in light of projected low fixed income returns over the next 10 plus years.
Okay. Well, Dalyce, maybe I'll tackle that at first, and please add and interject if I'd missed anything. So the obvious benefits to diversification benefits to having alternatives in portfolios. They especially given where we are. In terms of alternatives, I think we should also think not each alternative not every alternative is equal. What I'm saying is that I think we can dice and slice that into real estate, into hedge funds, into infrastructure. And so it's defining what's most appropriate for the overall portfolio in the context of what you already have, so that there isn't any undue risk in adding the wrong alternative asset class to your portfolio. When we looked at the landscape for alternatives at Leith Wheeler, and we took about 5 years looking at it, one thing that we struggled with was the additional fees that are associated with alternative investments. And so the area of infrastructure was probably the first step that Leith Wheeler took into allocating to alternative asset classes. So we have a strategic partnership with an infrastructure specialist, and we invest through them. And what that solves the infrastructure is that it provides bond type characteristics through income yield, and is also an inflation hedge just by the nature of the asset class. But it does have some equity associated type risk. So it's a hybrid between equity and bonds. So I suppose to answer that, and I've taken a long way of saying it, is that it depends on what alternative asset class you're looking at that will be most appropriate fit for the portfolio.
Right. And just this question also kind of ties into this, just to talk a little bit about socially responsible funds as part of a mix for conservative risk tolerance. And as you know, this is a growing area of interest with community foundations. So anything you want to shed some light on there?
Can you repeat that again, please?
It just says, can you please talk a bit about socially responsible funds as a part of a mix for conservative risk tolerance?
Okay. Yeah, and so I think when you are looking at socially responsible funds, there is going to be again a decision of whether that fits into your impact investing bucket, or whether that's going to be a strategy that's publicly traded, but it excludes certain certain investments, such as non-tobacco related, just as an example. And each of these have different risk and return profiles. And there's socially responsible funds sometimes, or impact investing, should we say, sometimes there's a compromise of the investment returns because of the social returns that are achieved by investing in them. So from a conservative portfolio perspective, or from an aggressive perspective, there is a compromise on the investment returns. Dalyce, I don't know if there's anything that you would add to that.
Yeah, I would maybe just add a few comments. I mean, in the early days of considering what socially responsible products looked like, you could unfortunately often look underneath the surface and find that these specific packaged funds were holding a lot of the same securities that you may have been in another portfolio. And then because of the way that they're packaged and the type of product, they were actually just incurring a higher fee to hold them. So thankfully, I think the industry has come a long way in this perspective. And I think that there's a lot of firms out there that take these principles very seriously, whether or not they're actually, packaging it into a socially responsible fund. So every individual's idea of what is socially responsible is going to look a little bit different. So I think the most important thing is that you can sit down with your investment manager and have an open conversation and say, these are the pieces that are important to us. How does this match up with the way that your firm talks to CEOs, selects securities, excludes certain sectors perhaps? And just make sure you're having an open and honest communication about that, because sometimes it is a little bit of give and take, but sometimes that's okay, depending on what your priority is as a foundation. So certainly important, and I think certainly a focus for a lot of investment managers more and more, but it's going to depend on your needs.
Yeah, great. Thanks, Trevor and Dalyce. And I will mention, and I'll highlight it at the end too as well, we have a webinar next week on Monday, November 23rd, that addresses, the ESGs as a tool for building a resilient portfolio. So we'll go into a little more detail on that. So if you're wanting to deepen your learning in that area, please join us next week. So another question, a couple more questions here. Can you please talk, after fees, roughly what percentage of investment managers beat the index over a 10-year period, both Canadian, US, and international?
Yeah, so we could spend a whole session on this again. And there's been a lot of studies that have been put forward, and this really speaks to the debate of active versus passive management. And when we do look at those studies, the overwhelming evidence shows that active managers, and I say active managers in inverted marks, because active managers tend to underperform after fees. And the reason being, a large quantity of those people, those groups, active managers in those studies, are not true active managers. And what I mean by that is that they don't have a high active share component. They don't deviate that much from the index. And so this type of group of managers we call index huggers. And so index huggers, after paying their fees, are going to underperform passive indices. And so when you're identifying or looking at those studies, please be cautious when you read that in media, because it's not, there's a large group of so-called active managers that skew those results. and identifying true active managers that are brave enough to be different from the benchmark are the ones that are worth paying for. And so I just give you an example, and this is just to get the point across, and not an advert for Leith Wheeler, but our Canadian equity fund since 1982, 38-year period, has annualized 3.5% per annum over and above the S&P TSX. So 3.5% on a one-year basis doesn't sound like a lot, but when you compound that over a 38-year period, the dollar value is significant.
Maybe I'll just add to that quickly as well, Trevor. A lot of these studies, they assume that when you're taking more of a passive approach, that you are able to set it and forget it. And has been shown time and time again, we're all human and emotions do get in the way of those strategies. So it's really important to know what value comes along for you or your foundation with having that person who can guide you through those moments in time, kind of make you take a pause, think about the long-term strategy, and make sure you're staying on track. So.
Thank you so much, Trevor and Dalyce. I've got a couple more questions, and I recognize we've got about 2 minutes left, but one is around gold, thoughts around gold in this environment and the views on gold.
Yeah, so we don't have a specific view in-house in gold. We don't invest in physical commodities at Leith Wheeler. I can share that, you know, it is certainly a discussion point, given that fiat currencies all around the world and central banks are printing money and creating stimulus for their particular countries, and currency is a relative game. So if we think about it in that context, the US are doing it, Canada's doing it, Europe is doing it, all developed economies are doing it. So currencies shouldn't deviate specifically too much for that reason alone. But then gold, as the question refers to, is a store of value. It's a hedge against the US dollar, and it's a commodity that people typically, or an investment that typically people rush to during times of uncertainty. And so the only caution I would have is that we've already experienced a significant crisis and a time of uncertainty. And so is that fully priced already in the gold price? I'm not going to comment on that or say a view, but I'm just going to leave that as open.
Thank you so much for that, Trevor. And you know, it's an interesting watching it. So I think that's part of it, is the view of people watching. We also have a question here around portfolio performance and reflecting on benchmarks and understanding the challenges between benchmarks and annual rate of returns. So the question is, on reviewing portfolio performance, is it better to assess the portfolio performance to achieve an annual rate of return, or a performance relative to a set of benchmarks?
I can start on this one, Trevor. I think, you know, again, I'm probably sounding like a little bit of a broken record, but if you can keep yourself focused on what is that metric that you yourselves need for either your individual portfolios or your foundations, and that comes down to a lot of the cash flow planning, et cetera, that might go into play with your advisor. But you should be focused on that total return. You should have a broad understanding that every year is going to look a little bit different. But you should be having open and clear communication around what those return expectations are and how realistic it is to achieve. So benchmarking is certainly one way that you can go about comparing performance of your portfolio to the broader space. But I'll give an example, you know, in a year like 2016, where there was a massive recovery through the energy markets, in particular here in Canada, you see a lot of managers underperforming the TSX index by substantial margins. And so your manager should be able to come to you and say, you know, the reason for the underperformance against that benchmark is because we weren't willing to take an extra step of risk and have overexposure into that space. So, you know, just a couple of ideas there, but both are important, but it all has to go into the context of what you yourselves need.
Really good points, Dalyce. And I'm going to move to our last question, which is coming from a member from an investment committee, is how do we weigh the reserve buildup with the holder's expectation about giving from their accounts? So truly, you know, balancing between the reserve buildup and then also on being able to grant and give back to the community.
Yeah. So yeah, I'm just trying to think of an example where, and maybe this COVID situation might be a good example. So having that buildup of the reserve kind of would have created some optionality of being able to give from either the reserve or the long-term fund to the grant makers, if that is. Am I understanding the question correctly? That this is giving to the community in need from the reserve fund or the long-term fund? Is that the question at hand, or is it balancing the donors' expectations for what they've donated to the community?
Based on the question here, yes, is looking at the grant holders' expectations, or pardon me, the fund holders' expectations. So how to manage and weigh the reserve build up with the expectations from the grants, the funders and the donors.
Yeah, and Tracy, I agree with that, your explanation of that, because to build up reserve fund, you want to take some of the surplus from the good years and put it in a reserve fund for the years that are not so good. The trouble is you've got expectations from the long-term holders that their funds be used for their particular causes. So my question was just how do you balance that, and what kind of responses do you have?
Yeah, so unfortunately it's difficult because it's complex and multiple people involved in expectations, and so you're right. The reserve fund is meant to be built up during those years of surplus, and in fact the argument can be on the other side that it's also a drag on performance to have a reserve fund during those strong periods of time. So I don't think that there's a one answer that fits all. I think it's having the discussion so that as many counterparties are appeased as possible. I don't think there'll be everyone might not be happy with the results, but this was really an illustration of how it can act as a buffer during those difficult periods.
Trevor,
Can I ask one more question? Do you have any strategies where you kind of do inverse investment of the reserve fund versus your portfolio, such that, you know, if you invest in the very same things, if they go down, they go down. If they go up, they go up. Do you have any ideas about that?
Yeah, well, I mean, typically, you would think that would be naturally already happen, because the long-term fund should have a longer element of growth, so a compounding effect associated with it, because it's a riskier portfolio. And so you'll have equities in that portfolio and other risk assets which should grow over time. And then your reserve fund should be populated typically with risk-free assets, so lower risky asset classes being cash and bonds primarily. And so they should be uncorrelated anyway, so that in the bad times, when your long-term fund is struggling, your reserve fund should be doing well. One thing I will say is that bonds and equities are uncorrelated, but it doesn't mean that they always move in the same direction. In fact, on many occasions when equities have fallen, bonds have also fallen, unless it is government bonds. If it's just government bonds being the risk-free asset, then it will be have a negative correlation with your longer-term fund, which will be primarily equities.
Thank you so much, Trevor, and really appreciate the discussion on the in-depth questions. You know, and as we know, the importance of having a reserve is key and a topic right now, and your support today in providing some tremendous thoughts was really important for our people today. So Trevor and Dalyce, thank you so much for your time. Thank you for your expertise. We are very honored with your partnership, plus also honored with your commitment to help our movement to be stronger. So Dalyce, can I ask you to go to the next slide, please? So as you can see, Leith Wheeler is an amazing organization. You've seen from the presentation today, but they also have a widespread connection across our nation. So would you like to offer any last comments, Trevor and Dalyce, as we close? And then I'll just go into the closing and announce for our next sessions coming up.
I would just like to say thank you so much. It was really good to be with all of you today. I know that there were a lot of questions, and these were very deep questions that couldn't be asked and answered in 30 seconds. So if you did want to send Tracy or Cindy these questions, we would be happy to answer them, you know, in thoroughness in emails directly to you. Thank you very much.
Wonderful, Trevor. Thank you. And again, you know, as we mentioned at the very onset, we appreciate your leadership, not only in supporting us today, but also in our ongoing efforts to ensure that our vital signs projects are strong across our nation, and how our values align, values from your corporate perspective, but also the perspective of Community Foundations of Canada. So we truly extend our appreciation to both of you and to your team. Thank you so much for your commitment to all of us. So next slide, please. Thank you so much, Dalyce. So as Cindy mentioned, we do have our session that's coming up on Monday on ESGs, and I encourage you to follow our events page. You can sign up from our events page if you'd like to dive a little bit deeper in understanding the ESGs, pardon me, and how this works within your investment portfolio. We will also be touching base on the SDGs, which are the Sustainable Development Goals as well. We have just also launched, we'll have a feminist grant making session that will be taking place as well next week. And this is looking at how we go, and as we are dispersing our funds and looking at our grants, how we look through it the lens of feminist grant making. So we're quite excited for that session to come up next week as well. We do also as well on December the 9th have a session that is specifically for the treasurer's role. We encourage treasurers, leadership team members, staff, etc. to join us, and we'll be diving deep into what are some of the critical controls that are required and necessary and risk management strategies. And moving into 2021, if you can believe it, we're already moving into the next year in our scheduling. Our very first session in 2021 will be exploring trust-based philanthropy. And that's around looking at the shift of power and how we are continuing to manage through our organization and our everyday operations, plus also in our leadership role, and how we shift and look at trust-based connections, philanthropy, grant making, donor relations, etc. All of these events are included or will be included shortly within a very short period of time on our events page. So I encourage you to stay in touch with us through the events page. You can always stay in touch with us as well via our email. I will be following up with an email to all of you today, thanking you for joining us, but also with a feedback survey as well. And this presentation will be uploaded onto our website. So you can also follow the resource library and you'll find today's presentation plus others as well. So as we close, thank you. Thank you so much. We've gone a bit over time and I appreciate your extra time to be with us today. You know, Trevor, as you mentioned, we did dive deep into some very, very tough topics and some good topics. And we appreciate that opportunity. So everyone take care, stay well, and we'll look forward to seeing you at a future event. All the best. Bye-bye.